All right, thanks for joining us, everybody, and welcome to the webinar. My name is Clay Malcolm here at Advanta IRA, and I'm joined by Jennifer Barner, founder of Lighthouse Ventures. Jennifer, how are you today?
I'm doing great. Thank you for having me.
Delighted to have you, and thanks for sharing your expertise with us today. So, today we're going to be talking about IRAs and their ability to invest in real estate ventures. And Jennifer's going to share her insight in terms of finding a multifamily property and kind of how that mixes in with other real estate asset choices as well. And so, she has a great case study and a method that she used. And so she's going to share that with us. And so it's going to hopefully help all of us who are real estate investors to kind of understand and conceptualize how we might choose to do that as well. I'm going to go ahead and start with a little bit of IRA information, just for those of you who are not as familiar with self-directed IRAs. And then Jennifer's going to be providing the bulk of the content, and so I'll give her the controls here just in a minute. But let's go ahead and start with the IRA slides. Oh, there's me. I turned the video on, so I guess we don't need that. The only thing that I'll really say about this is that I have been in the business for about 10 years, and I also am a self-directed IRA investor myself, and I have a number of real estate assets. And so I really have a personal understanding of what we go through as self-directed IRA investors and the choices that we make and executing those investments. So I'm happy to talk to you about your accounts or the type of investments that you're trying to get into and that kind of thing, and see if there's a match and see if Advanta can provide some services for you. All the education in this, all the information in this presentation is for education purposes only. At Advanta IRA, we don't give tax, legal, or investment advice. We don't advocate any particular investment strategy or investment vendor. Our role in the equation is really very neutral. Our job is to document the activity of the account so that you get to keep the tax benefits, even when your IRA is investing in real estate or other alternative assets. And we certainly encourage you to engage your financial team or your legal team anytime that you're vetting an investment that you're considering for your IRA. And just a little bit about Advanta. We are a customer service oriented organization. We've been around since about 2003. We're a medium-sized company in the self-directed IRA custodian space. This says 1.3 billion, but we're actually probably closer to 1.7 billion at this point of assets that we do the administration for. Every investor that comes to us gets a two-person team, kind of an education and onboarding person like myself, as well as an account manager who's kind of a back office, more nuts and bolts person to help you with investment paperwork, as well as anything that might come up for your account in terms of questions, billing, payments, dividends coming in, any of that kind of thing. So, and you have those two of us, you have our phone numbers and our emails, so you actually know who to contact for information. And Advanta does a great job of keeping us educated and making sure that we have the information and the resources that we need to make sure that your IRA experience is a good one. So when we're talking about self-directed IRAs, remember that what we're really talking about at its very core is combining the tax advantages of a tax-advantaged account, and the account types stay the same. They're the ones that you actually already know. So traditional IRA, Roth, health savings account, SEP and simple IRAs, ESAs, and lots of times people are moving into these accounts from an old 401k or an old 403b or other type of retirement account, thrift savings plan, defined benefit plan. So those tax advantage accounts often can be moved into a self-directed IRA account. And the reason that you would want to do that is because a provider of self-directed IRAs is giving you the opportunity for that tax advantaged money to invest in alternative assets. And today we're talking about real estate specifically, but what you're doing is combining the tax advantages of the account type with the returns that you could get on a real estate deal or other alternative investments. So that's really the combination that we're talking about here. The account types don't actually change. Same contribution rules, same distribution rules, same tax advantages as your traditional or Roth at your bank or brokerage house. The thing that's really changing is what you can invest in. And so at Advanta, we've taken on the challenge of being able to document the activity of an account that purchases alternatives. So real estate is by far our biggest asset class. And that's obviously varied because real estate encompasses so many things, and Jennifer's going to talk a little bit about that in her part. But all kinds of alternatives, anything that's allowed by law. So cryptocurrency, we do precious metals, private lending, private equity, and so any of those things. And one of the things that's kind of a cool thing about self-directed IRAs is that if you know how to make money outside of your IRA, often you can take that same expertise and sometimes system and put it in your IRA and combine it with the tax advantages. So if you know how to make money outside your IRA, often you can make money inside your IRA the same way. You just have to take a little bit of time at the beginning to set it up properly so that you get to add the tax advantages. And today we're going to be talking some about multifamily, and so I threw in a little bit of information here about syndications. And the due diligence, as I mentioned, is up to the account holder, and there are all kinds of things that you might want to consider when you're choosing a multifamily syndication or an investment of any type. But I put a couple of them here just to kind of give you a starter kit, so to speak, on what you might be thinking about. So which market do you want to be in? Your IRA does not have to invest in your local market, but you can, of course. Are you going to be working with principals and operators of the property and the acquisition? What's their track record? Doing due diligence on those folks is a good way to kind of get your due diligence process started and to understand who you're working with. Disposition strategy. So, different syndications and actually, LLCs and other types of private entities that are created to go out and invest in the real estate world, they have different plans. What's their timeline? What's their exit strategy? If their first exit strategy doesn't work, what's their second exit strategy? Things like that. All of that can kind of affect whether you feel comfortable investing with them and that it matches your financial needs. And that's really the goal there. Level of transparency. So obviously you'd want some information about not only the investment at the beginning, but also through the period of the investment cycle. So learning how you're going to get information and find out what's going on with your money is often a nice criteria to kind of nail down ahead of time. And then timing of returns. IRA money, when it invests, obviously it has the same distribution rules as you're familiar with, and 59.5 is a very kind of threshold age for these accounts in terms of taking distributions. So finding out, the timing of the returns of the syndication as it relates to your age and your financial situation is really, it's a thing that should be considered because you need to have that be in concert with one another. It may be a big factor or it might be a small factor, but understanding when the returns are going to come and what the sequence of events is going to be is often something that is a helpful part of doing your due diligence. So just some considerations there. And again, this is all something that we at Advanta, we don't do the due diligence. So this is the account holder and their financial team deciding on these things. And then, getting started with a self-directed IRA to invest in real estate is really very easy. And this is going to be my last slide before I turn it over to Jennifer for the bulk of the content today. But a lot of people think that this is going to be a very complex or difficult process, and it's really not. So you just open up an account with Advanta. Obviously, that account is a legal and financial entity, your IRA, whether it's a traditional or Roth or solo 401k or any of the other account types we talked about. You want to move some money in there, you can do that via transfer or rollover, and done properly, those are moves of money that are not taxed and they're not penalized. You're really just moving it from one account to another and putting it in position with a custodian that handles alternatives. You can also make contributions if you're eligible to do so. So then you have an account that's open and has some money, and then off you go. You're out looking for investments, and once you find those investments, you work with your account manager here at Advanta to document it. So we get the paperwork together, and the IRA disperses funds to close the deal, and then your IRA receives the returns. So it really is a relatively easy process to get started, and something that is very similar to the IRA function that you're used to. It's just that your IRA is going to make money on real estate instead of on mutual funds and stocks. So again, any questions about that, please feel free to contact me, and I'm happy to walk you through any of it. And frankly, any questions that you have on any of the content today, if you'll go ahead and type those into the questions box on your GoToWebinar console, that would be great. And we'll take questions at the end and have a little discussion as Jennifer wraps up her presentation as well. So without further ado, I'm gonna give Jennifer control of the slides here. And I'm gonna introduce you to Jennifer Barner, founder of Lighthouse Ventures and a real estate investor and operator in a couple of different spaces. So Jennifer, I'll let you introduce yourself a little bit more, but I'm really I'm happy to have you today, and thanks again for sharing your expertise.
Thank you. So
Yep.
Clay was gracious enough. We were having a little bit of some technical difficulties like we all do, and we've all been having to adapt and pivot through all this COVID stuff. So I appreciate your flexibility, Clay. Thank you so much for having me here today. And I apologize if my slides aren't beautiful and elaborate like they were. They were, but I it's just the way things, you just gotta go with it sometimes. So anyway, Clay and I, he was so gracious. He reached out to me about 8 months ago, and he noticed on LinkedIn that I was doing some multifamily and real estate things, and he thought that we might be a good fit. And so that's how we came to meet. And I was intrigued with Advanta. And what I loved about Advanta, before I get into multifamily, is that they hold your hand through the transaction. And I can tell you, I don't have my IRA with Advanta, and I wish I did, because all my transactions are held with another custodian. And every time I go to use my funds with that custodian, I know that I'm going to hit barriers. I know it's going to take me 2 to 3 days of banging my head against a wall to get through that transaction, because we don't have account managers assigned to us. I went with a really big firm because I didn't know any better, and I didn't really have anybody kind of educating me on the best custodian out there. But what I can tell you is, for those of you that have your funds with Advanta, you're in the right place. They have actually, I've sent many people to them for the syndication that I just got done closing on, and they made it so easy for each and every person that got involved in my investment. So I'm really excited to be here with you today. And I hope that other people will find it as easy as my investors did, and I'm sure they will. So they're all in a very good space. Having
Thanks so
you.
much, Jennifer. I appreciate the kind words.
Yeah, absolutely. So with that, a little bit about me. So I'm a stay-at-home mom of 4 children. I am happy to report that my children are now 20 to 27 years. We had 4 children in 6 years. So we were, just trying to keep our head above water for so many years. I married my high school sweetheart. I went to school and I got a finance degree. Although coming out of college, I ended up at Microsoft at a time when nobody had heard of Windows. So I'm really dating myself here. But I didn't know how I would ever use my finance degree. And I was a little bit hurt when I heard that you could actually invest in real estate with your IRA, because that's something that they never shared with us when we were going through the finance in college. So anyway, I'll talk a little bit more about that a little bit. But I started in 2008 when the stock market crashed. We had given all of our funds over to another person to manage our investments. And when that crash happened, we quickly realized that there weren't any stops in place to help us to protect our investment. And so my husband and I became very avid learners about trying to figure out what are ways and different vehicles that we can be investing in to rebuild our nest egg as quickly as possible. And so one of those vehicles was network marketing for me. I got into network marketing because of this whole concept of passive income, making money while you're sleeping, right? Isn't that what we all want? It was about 7 years past network marketing that somebody introduced me to this whole concept of real estate through the Rich Dad program. And they said, hey, will you just come to this seminar and listen to this whole Rich Dad program? And I didn't know anything about Robert Kiyosaki, hadn't heard of him, didn't know anything about the Rich Dad program, but I was in love with the concept that I could buy and sell real estate without having to have a license of any kind. I could take my kids with me. I could flip properties. I could make rental income. I mean, all of it was just so intriguing to me. And I told my husband, we need to do this. And he, of course, is my biggest cheerleader. And he said, okay, you know, if that's what you think we need to be doing, and if this feeds you, then great, you know, go for it. So I invested a lot of money into my education to be in real estate. But I will also say, because I did, I quickly jumped in and did as many transactions in that first year as I possibly could. At the end of that 1 year though, I realized I want to go bigger and I want to go faster. How do I do that? I knew that it was going to require a team. And I thought, from listening to various podcasts, I thought real estate and multifamily is really where I need to be. So I was on a search for a coach. And when one of these podcast gurus offered up his coaching program, I immediately signed up. I was sold on that. And then fast forward to today, I just closed on a 72 unit, which I'll discuss here in a little bit, but really excited. It's been a fun journey. It's opened doors that I would have never seen possible. So I'm thrilled to be here today. And I apologize, Clay, I'm trying, there we go. So that first year in real estate, I'll tell you, I leveraged my IRA because we had this pool of funds and it was all tied to the stock market. So we were looking for a way to diversify in a way that wouldn't put all of our assets at risk again, right? Like 2008. So I started investing in real estate. I made some errors there, and you know, I'd be happy to share that if anybody wants to know what I did wrong. But anyway, I bought properties with our IRA. I then went on and flipped some properties. And the last strategy I used that first year is applying the BRRRR strategy, which is when you find a real estate property that you really like and you want to hold on to it. You put your funds into it, you rehab it, you find a renter, and then the last part of that BRRRR strategy is to refinance with the goal of recapturing all of the funds that you put into that project and have no money in. And that's when you receive infinite returns. And that's really your objective. And I can tell you over the last year, we've put together a portfolio of properties. And because of the exponential growth that we're seeing and the value trajectory going up on everything, no matter what greater MSA you're in, we were able to pull out all of our funds out of a 12 unit portfolio. And so now we're having infinite returns on that too. So it's really been a fun space to be in. I've really, you know, as much as people love the stock market, I can't say enough powerful things about real estate. So activities leading up to this 72 unit, I will say that I became very myopic. After I went to my very first boot camp, that was in 2017. I was enamored. I did everything that I needed to do out of the gate to make sure I was going to hit the ground running. I found out I live in the Kansas City area. Everybody loves the Kansas City area. It's a great stable place to be. And when everybody else is having highs and lows, you know, Kansas City just keeps on clicking. And we don't suffer those highs and lows like the rest of the coasts do. So I became very myopic and figured out if I can be boots on the ground and find a deal here locally, then the money will show up. There's plenty of people that love Kansas City that I know that I just needed to find a deal here. So over that next 18 months, I analyzed with another person over 250 deals. And what I heard very loud and clear from other syndicators is you don't want to just hit a single. You want something that's going to be a home run out of the gate, because if your investors have a home run and you make them money, then they're going to line up and they're going to keep feeding you more and more money. every single time you have another deal. So it became very clear to me that I just needed to find something here in my backyard, and it needed to be a home run. That's all I needed. Unfortunately, after a year and a half, I couldn't find anything. And I admitted to my coach that I was a little exasperated with the process, that I was coming up against a lot of big syndicators, and the numbers just didn't work out to where it made sense. So I actually went back to flipping properties, and in that next year did 28 properties along with somebody else that I had met through the multifamily boot camps. And he and I partnered. We renovated 28 units. We kept 12 for ourselves, and that's the one where we just refinanced that entire bundle of 12 units. So we had a couple fourplexes, a duplex, a single family property. We refinanced and we have zero money in now. So that's the beautiful place to be. The other thing I did leading up to this 72 unit is I became a limited partner in other people's deals. I never realized how much confidence comes when you invest in somebody else's deal. Because all of a sudden, when you're having a conversation with a broker, and instead of saying, I've got some single family homes and I want to get over here into multifamily, the conversation quickly becomes, yeah, I'm an investor in 230 doors, and I'm looking to go elsewhere in the U.S. Do you have anything? The conversation immediately changed, and you instantly have credibility with these brokers when you're talking to them. So if you're in a place like I was, and you couldn't find, and you can't find anything in your current market or another market that you really wanted to get into, there are other people that are having success. And there's no reason why you shouldn't invest in their deals as a limited partner so you can build up your own resume. I also became part of a 403 unit that's down in Shreveport. We still own that one. The 230 went full cycle. And so I got to witness, the start to finish on that property. That one played out exactly as they had projected. The 403 is not, and I will discuss that a little bit further here shortly. But then I've also gotten involved in a development fund, and it's not like the other properties that we're invested in at all. We're kind of a loan for another property that's being built out. So it's a new development, and we'll get those returns this year. So I'm excited about that. And because that individual, that particular syndicator, has treated us so well and he's made us money on these deals, he's got another one, and I'm lined up right in line to invest in that. So that's right on the horizon too. So when you're looking for properties, you need to first determine what's your criteria. And I can tell you that it doesn't matter if you've got the newest property in town. If all of a sudden all the jobs leave because of COVID or because of a new president, it's irrelevant. Your property has no value to anybody. So the biggest thing you want to look at is, where are the people? I can tell you over 20% of the population moved between 2020 and 2021. That is a huge number. And they're all fleeing south and along coasts. People have realized that they can live their best life now. They don't need to wait until they're retiring to live in sunshine and where they can have a better quality of life. So you want to make sure that you're accounting for the growth and unemployment when you're looking at different metros. So people say all the time, well, have you found a deal? Have you found a deal? Well, you can find deals all day long, but are they the right deal for you and the right deal for your investors? Your investors don't want to be in something for the next 20 to 40 years. So if you're looking for a deal and you find a syndicator that you really admire, make sure you're looking and doing your due diligence on that particular property, because I'm seeing deals now that are 40 years out. They're promising the same returns that I'm promising on a deal that I just did that's a 5-year hold, but theirs is projected over a 40-year hold. The question is, how old will you be in 40 years from now? Will you even be alive? I mean, that's a crazy thought that you have to put money in that you won't see for 40 years. So when you're beating your head against the wall like I was, or if you're doing that now, let yourself off the hook a little bit. They're not as easy to find right now because it has become so saturated from other people flocking from the office space into ours. The other thing you want to look at is population. I look for a population greater than 85,000. I look for a median income greater than 50,000 because you want to be able to support the rent for those buildings. And I always hedge on what is a third of the rent for that month. So if you take 50,000 and you divide that by 12 months, you're around $4,000 a month in income. Now, if you take a third of that, can that support the average rent on those apartment buildings that you're looking at? And that's what you want to make sure. You also don't want to, this has been my mantra, you don't want to be in a one-horse town. If you're in a town that is just supported by a university, you can see what COVID did. That was one of the things that my mentor said never to do, is never get in a one-horse town, because you never know when that town is going to shut down their university. So we've seen it this year. I know that my boys are both at a particular university, and lots of parents didn't send their kids back to school because they didn't have to. They were studying remotely this entire year. You also want to look at the growth of an area. It needs to be positive growth. You also want to make sure your unemployment in that particular metro is less than the US average. And I can tell you the US average right now is at 6.1%. So if you're analyzing any particular metro, one great source that I always turn to is data.io.usa. It's an easy place to go to, and it will give you all the metrics for that particular city. Now, when you're looking at your team and your role, I would really like to ask you, what kind of time do you have to devote to this asset? Because when you're saying, hey, I want to go be a general partner in a multifamily property, you're all of a sudden no longer in a passive investment role. You are now the driver of that vehicle. So, my husband and I, we were just having a conversation, and I said, we need to be selling our rentals right now. This is the perfect time. The market's exploding. There's no better time than now. He's like, honey, it's all passive right now. Don't worry about it. Just let it ride. And I'm like, it's passive for you because you're in the passenger seat while I'm running all of our portfolios. So it's no different as a limited partner versus a general partner. If you've got the time and that you feel like this is your passion, then I'm going to encourage you, yes, you want to be the general partner in a deal. But just keep in mind, you will be on a call every single week managing the property manager, if you've got a property manager, or if your property is large enough to support one. If not, you're going to be managing that, and that is going to be like your baby. If you have children of your own, you know what I'm talking about. So every tenant or resident becomes a baby to you. So you just want to make sure that you have the time to actually step into the driver's seat and manage that. If you can't, maybe you have funds that you can bring to the investment. And in that position, you want to make sure that you look at the syndicator. Do you trust them? Are they a person of integrity? Do they have credibility? What kind of real estate resume do they have? So that was something I took very seriously. And when you go to these different boot camps, and if you haven't, I would suggest that when, all restrictions are off, and the sooner you can get to one of these, those are great places to go where you really get to know the people and you can build your team from there. I mean, I've been really blessed to have found my team from that 2017 boot camp that I went to. and I got connected with my local business partner here in town. And you learn who you want to fly with, basically. With that, if you are a general partner, or if that's a position you want to become or move into, I'm going to suggest that you get your financial statement in order. If you don't have one, reach out to me. I'd be happy to share a financial statement that I have, that I love using. It became very easy. I felt like I already had the pieces in place. So when we got our deal under contract, and when Fannie Mae was asking for the paperwork, it was already done, and I just gave it to them. In the same token, on the back of my personal financial statement, I have my real estate resume, and I have it broken down by property, how much I owe, how much debt is on it, what the hold time was. So those are important factors, because you're pretty much selling yourself to the bank, and you want to look like you are a good investment. And the only way to do that is to monitor your real estate and what you've done over the life of your real estate career. So don't underestimate anything, whether or not you're loaning on, or lending, doing private lending for others. The thing is, you have to assume some kind of role, and you want to document that and show the banks that you know what you're doing. Some other considerations that came up because of COVID, and while I was raising money on the 72 unit, is the bank wouldn't let me take down this property by myself. Because this is the very first big syndication that I did, I needed to partner with a seasoned investor. And because of that, I was able to go back to this boot camp, and I just happened to be running numbers with another investor. And he's, when the deal analyzer turned green, he and I both were like, whoa, it just turned green. And so for those of you that have never found the Michael Blanc syndicated deal analyzer, it's a fabulous tool that allows you to plug in financials that you get from a broker and quickly analyze whether or not this property would meet your investors' requirements and returns, and your own. And so in this particular case, because of COVID, the Freddie and Fannie are requiring that you partner with somebody that has went through 3 to 4 business or full cycles on multifamily buildings. Along with that, the second bullet here is funding. You need to be able to show that you've got some skin in the game. Every single investment that I ever even consider is, one of the number one questions is, are you putting skin in the game yourself? And I know that when you're young, it's very hard to have money to put in of your own. But I will tell you that there's we've all heard the saying, there's no value in free. And if you're not willing to put your own money on the line, it's very difficult for somebody that's going to be a limited partner to put my money in your deal if you're not willing to put your own money in your deal. So think about that, and think about, okay, what do you got to do to be able to put or get some skin in the game? And then the second thing is, do you need to syndicate this property? You'll be surprised that you don't have to syndicate these smaller multifamily properties. Now, when you look at the loan options, you're not going to be able to get non-recourse debt on the smaller multifamilies, and maybe you don't care about that. But that was very important to me, and that's another reason why it's taken me 3 years to find that big multifamily deal that I could do, because I was insistent, if I'm going to take on a big multifamily property, I wanted something with non-recourse debt that meant nobody ever was going to be able to come calling after my own personal home or personal vehicles, or take any of our things if we should ever default. So for those of you unfamiliar with the terms, you've got recourse debt and you've got non-recourse. Recourse is typical of residential properties. You'll go and you'll get a note, and you've got to have the financial wealth to be able to cover that. They're not going to lend to you unless you have assets that can protect them, the bank. On the non-recourse, the asset stands on its own, and they can see that you probably could put anybody in the driver's seat and they're probably going to be able to run that asset very, very easily. But they want to make sure the right team is in place. So those are things to consider when you're going out there and looking for a multifamily. And the third thing is, while you're in the pursuit of finding your multifamily property, don't underestimate the value of posting on social media, even the smallest little things you're doing, because that is how I was able to raise the capital I did. I didn't realize that all my little social media posts that I was putting out there, that they were making a difference. And when I went to call on people and say, hey, would you invest in this property? They said, yes, we've been watching what you've been doing and we will. We believe in you. And I just had no idea. So keep networking, keep connecting with people, use a CRM system that's going to be able to track those conversations because they will become important to you. When you find that first deal and you go to raise capital, you know, there's a very gray line there. Some people will say, well, you can take friends of friends, but then I've heard, no, you cannot take friends of friends. You can only take your friends, the people you know directly. So it's really great to start having those conversations as if it's already going to happen. And if you think about it, if you believe it, it's going to come. So you might as well just go ahead and start doing the actions necessary and prepare for the inevitable, which is finding that multifamily asset. So let's talk about the 72 unit that I found. So I finally heard somebody say they invested in another area outside of their backyard. And it was mind-boggling to me. I thought, oh my gosh, why have I been so hung up on investing in my own backyard or being just a couple hours outside of the greater Kansas City area? When somebody said, oh yeah, that they're investing across the country in some asset, I was like, wow, I could be doing the same thing. And I think a lot of that finally came from all the experience I had built up on the single families and the multi, you know, the 4 units, you know, renovating those 2 4-unit complexes. There's a lot of confidence that comes from that. And once you realize, you know what, having a big building is no different. And as long as you've got the right team in place, you can do anything. So when we were taking our boys to college this last summer, there's an area that we always drive through that is always littered with cranes, and you know, they're expanding highways, and that is growth 101, right? When you see expanding highways and lots of money being poured into an area, that's a sign of growth, and that's an area you want to consider. And so when I reached out to a broker, who I've done this on millions of occasions in my own backyard, I just happened to connect with a broker in another area. And I told him my experience, and he said he had something that he hadn't shared with anybody, and he happens to have the financials and wanted to know if I wanted to look at it. I was like, oh, please pick me, right? There's 10 of me lined up behind me. So I was thrilled that he had enough empathy for my situation, that I hadn't found anything, that he thought, hey, I'm going to give this bone to this gal and see what she does with it. And the numbers work. I'll tell you, initially, the numbers didn't work. And this is why you want to partner with somebody that is seasoned, because my business partner noticed that when we did our due diligence and we walked the units were actually smaller than what they advertised. And as a result of that, we were able to come back in and say, sorry, we offered you this number, and we know that your seller didn't accept this number, but because of the size of the units, we're actually going to lower our offer. Which, who does that? So to give you an example, the property was set at $4.2 million. We came in and offered them 3.9. The seller did not accept our 3.9 offer. And instead, we rebutted and say, oh, sorry, 3.9 wasn't our offer. Our offer is really 3.7. And the broker, I'm sure, is saying, wait, you're going the wrong direction with your offer. You mean you want to go up, right? And I said, no, we actually are going down because the unit sizes are smaller. And as a result, we need to offer less. And we held our ground. And I'll tell you what, the broker came back a couple weeks later and said, you know, that offer of 3.7, I think we can meet at 3.8 and get this deal done. I think we have a deal. And so I went to my seasoned investor and I said, hey, I think we got a deal at 3.8. He said, Jennifer, we're not in the business of futures. We're in the business of what we can count on, what are actuals. And what we know is what's on paper today. We can't base our purchase price based on what we think it could be. So we're going to hold. We're going to hold at 3.7. And I can't even believe that a week later, the broker calls me and said, hey, look in your inbox. You've got a signed LOI at 3.74. And I was ecstatic. So, you know, if you're patient enough, that the right deal will come to you. So again, I already talked about you want to be in a city with multiple industries. So this one has, you know, 7 to 12 different big companies in the area. The economic outlook is very, very strong. Unemployment was sitting at 2.9 when the national average at that time was 4.1. So it had looked, and that's pre-COVID. It looked really, really good. So as we continue to advance here, if you decide that being a general partner is not something you have time for, again, you want to consider being a limited partner. And that's where you put your money into an asset, use your IRA funds. And the beautiful thing is you kind of get to sit back and receive the interest payments from that, or, you know, and at the end of that 5-year trajectory, when you go to sell, you get to reap all the equity, you know, that multiplier effect. And that's why so many people are in it. And of course, the depreciation benefits as well. The second option here is a sponsor. You may be somebody that has a huge net worth, but you don't want the hassle or the headache of managing an asset. But people will pay you 10% to just be the sponsor on that note. And that means that your entire total net worth can support the total value of the property. So if you're one of those individuals, I would love to meet you, because there's, you know, you just never know when you're going to need that person. So it's an easy way for somebody that does have the means to step up and not have to manage it. The other thing you can do is, if you don't have the time to actually be in the deal every single week, is you could be evaluating properties. And this is what we call being a bird dog. And it's where you're going out to brokers, you're making relationships with them, trying to get them to send you the deals, where you do the underwriting. And when you find the underwriting and the deal works, you can then reach out to somebody like myself and say, hey, would you consider partnering with me? I need a seasoned investor to partner with me. And who's not looking for that? I mean, that takes a lot of time, but that's something somebody with a full-time job can do in the evenings, early in the mornings, on your lunch breaks, on your weekends, and it doesn't take too much away from the family. And it's not something that's a long-term thing. It's something that you can fit intermittently in your life. Now, whether or not you decide to be a general partner or you decide to be a limited partner, you always want to do due diligence on your teammate, or on the syndicator that you're willing to invest your time and money with. I actually invested in my mentor's property, and I took a flyer on it because I didn't understand how they were going to make the numbers work. And I say that because I had been rehabbing so many properties, and I knew how much money it took for us to renovate a fourplex and to go in and turn every single unit that was a Class C unit. And so when the numbers were being, explained to us in this asset investment opportunity, I wondered, how is that possible? I just didn't get how they could do it. So I told my husband specifically, okay, they're thinking they're going to be able to return 70% of our funds within the first year. And we will still hold our same position in that property. And it'll be a 5-year hold, and the rest is history. As it turned out, none of that has come to fruition. And it's because when they went in with their team, he was a brand new person to this particular team, and he was acting as the property manager. Things didn't go according as planned. In fact, the property was hemorrhaging. As for a 400 unit property, people were leaving as fast as they were coming in, and they just couldn't get control on that. And in the meantime, they're also trying to renovate units. And instead of going and doing one unit at a time, they were trying to go through them all and paint them all on, paint them all on the interior at the same time. And then do furnaces, and then, do kitchens. And you just can't operate a property that way. Unfortunately, that property isn't going very well. I just talked to my mentor on that. They hope to get this thing sold this upcoming October. We will all be made whole, but I can tell you we have never received a payment or interest of any kind on that property. So that's been a little disappointing. But again, trust your instinct. Oprah has a wonderful statement that I have used over the last several years in real estate. When somebody shows you their colors, trust them the first time. So when you see a deal that just doesn't make sense, you don't need to get in it like I did. Believe your instinct, trust your gut that it probably is not a great deal and that you can watch from a distance. I apologize. My dog is whining and wants to go hear what my family is doing. But anyway, so real estate at large, I'm wrapping it up here. We all know that people don't want to be in office space anymore. And unfortunately, those investors have, come into the multifamily space because we all know that everybody needs a place to sleep. And so why wouldn't you want to be in multifamily? Everybody wants to be in multifamily. On top of it, you have gurus that are doing multifamily summits and boot camps every 6 weeks now. It's crazy the amount of people that are in this space. We were already having compressed cap rates in this space because there's so much stimulus money that's out there. And that's pre-COVID, right? We had Trump and the stimulus that he did. You put so much money out there that it was driving all the cap rates down and making it so expensive to be in the space. But now we just multiplied that impact by putting out there, all these stimulus dollars. And so now I don't see the horizon changing. I know a lot of people are out there speculating that there's going to be a big turn in the market next year. But honestly, after talking with my guru or my mentor just a little bit ago, he agrees that he doesn't see that change coming either. He thinks we're going to continue to have a strong market for the next several years. So, and the last piece of this is we're all competing against institutional REITs. So they usually don't play in the space of 100 to 200 units. They're usually 300 to 400 units. So if you can stay below that threshold, you should be fine. So future of multifamily, like I said, there's lots of capital in the market, which means that the best part for you is it'll be easy for you to raise capital when you find the right deal. It's going to continue to be strong. You're going to see more and more multifamily builds. You're already starting to see the tertiary markets are getting as expensive as the greater MSAs, but that shouldn't be a deterrent. What it means is we need to adapt to the new normal and not be afraid to try it and to get into those deals. So everybody's expectations, years ago, I noticed that the ARR and the IRR were sitting at 15 to 20%, and now they've been modified and they're 12 to 18%. And I've even heard people lower them even more to get a deal done. So again, it's all perspective. There's so many benefits to being in real estate. I don't need to really go into that, but I would say if you're going to get in, get in. So with that, I don't know if there's any questions. I can't really see those. So Clay, I'll turn it back over to you. But if there's something that you didn't ask a question on and something comes up in the future, maybe tomorrow, please don't hesitate to write down my name and number and reach out to me personally. I'd be happy to connect with you and share whatever information I can that I might know.
Thanks so much, Jennifer. I appreciate it. I'm going to put both of our contact information on there because I also, if you have questions about the IRA part, I'm happy to kind of help you with that as well. So you have a couple resources there. And there are a couple of questions here that I'll just ask real fast. I know that we're coming up on our hour, but there was a couple of questions that came in. So, and if you have some, please feel free to go ahead and type them in. I'm happy to see if we can get to them. So the first one is, and this is a good one for me, are home runs still out there? This was the question.
Well, I would consider, I will tell you on this property that we took down, it's turned out to be a home run. And here's why. The rents are going up astronomically right now. We aren't even touching the units, and we're already achieving our projected after repair value before we've even touched them. So, if you can be very conservative in your underwriting, I think you can find there's always that that pin in the haystack, right? If you turn over enough rocks, you're going to find the right one. So I wouldn't give up on multifamily. I would say that they are out there because people are doing deals regularly. You just maybe need to change your expectations on the investment that you're going to get back from it.
And I would just, from my experience as seeing IRA investors, we haven't seen any real slowdown in terms of IRAs investing in multifamily syndication. So, your comments about that there's capital out there and also that there continue to be deals that are worth doing would be consistent with that. So it's interesting that I know that some people are feeling pressed by all the attention, but next question, and this is kind of along the lines of another one somebody sent in, but I'll ask it this way. So what are your lessons learned? What were your main takeaways from that experience?
From the 72 unit, your team is critical to your success. Well, first and foremost, I partnered with somebody that's very analytical, and it's made all the difference. You need to find somebody that pairs nicely with your personality type because it's like a marriage. You'll be with them for the next 5 years and you'll be on calls with them every single week. And if there's something in there, a personality trait that you don't really care for, it's really going to become magnified over time. And so the other thing is your property management team. They really need to be in alignment with where you want to take the property because they could kill the deal overnight. So you just need to make sure that you're all on the same page. So for me, the lesson is your team has to be a heavy hitter team for you to have a home run.
Well, and one of the questions that came in was probably early on because I think it was when you were talking about the limit going through the 250 different deal analysis. So, and the question was, they wrote was, what type of things were the easiest eliminators? What were the things that you just kind of threw out right away? Do
Uh,
you remember?
oh yeah, I will tell you that this is kind of funny too. Flat roofs, boom, off the table. If they hadn't been done, wouldn't even consider them because they cost so much to do.
Hmm.
Um, Also the area. You know, if I know that the area is not a good area and it's not trending upward, I don't even look at it. I don't care how good the numbers are. You know, if you have to give it away, it's not worth owning, right? Um, yeah, and then the market, you know, if the market, again, I live by the population and the median income. Because if those two factors aren't there, and the third thing is if the industry. I mean, I'm looking at deals every single week. I probably look at 3 to 5 deals, and I just immediately can scratch them off. If if I pull it up in Data USA and there's only one industry, it's a game changer. I won't even go any further. So,
Hmm.
not everybody has these same standards, but I'm learning from people that have already walked the path that I'm on. And
Hmm.
there's a reason why they tell you these things. And so I don't need any harder lessons in life to learn. I'd rather take the straight and narrow than have to go like this my whole life, right? So anyway, I'm trying to learn from those that have already walked the direction I'm going.
And so, Data USA, what's the exact address again? Do you know it off the top of your head?
Well, I think I typed it right, but I think it's data.io.usa,
Okay.
or it's a derivative. If you start data.io, you'll get there.
And this is a question I asked some of the other experts that I'm lucky enough to interview. Do you have other data or websites or data sources that you use that you're willing to share? I mean, it sounds like that one has a lot of the information that you're looking for, but
I think census.gov might have another one. Let me think. I mean, that's the one I routinely go to. And I rarely have to, I mean, I'll use Renometer, right? That's a good website to get a handle on, and apartments.com. If you're trying to get a gauge on, can it really get the projected rent that you're
hmm,
aiming for? So as you're doing your projections, can it really achieve that? I'll use Renometer or apartments.com to see what the area is generating.
hmm. All right. And I'm going to just go one more question. I realize that we're at our time, but hopefully this won't go over too much. So it says, when looking at a syndication, what time frame would be ideal on return of investment?
Well, I think anything beyond 5 years is expecting a lot of your investors. So ideally, you want to have it. I mean, it's a personal decision, but I think most investors that I've ever talked to want their money back within 2 to 5 years. Now, you may set it up, and what we did on our unit is we said, hey, our goal is to find a new buyer for this property at the end of, at year 5. Now, in the event that the market is not cooperating, we may have to hold it a couple extra years. So you need to be comfortable holding it, for us having your money for till year 7. And if you're not, then this is not the right investment for you.
Mhm.
So I think being transparent with your audience is really, really key. But beyond that, I think it's a personal thing. But my experience has been 2 to 5 years.
Nice. Well, again, Jennifer, I really appreciate you spending some time with us. We're going to go ahead and wrap it up. Any parting thoughts for the folks who attended today?
I hope that you don't get frustrated and quit. I see so many people in real estate. They get in, they pay all this money for gurus to help them, and 8 out of 10 people never do anything with it.
Hmm.
And there are a lot of good people doing a lot of good things. and you may be a little bit unclear on the right process, but you, Clay, are providing a lot of great value and a lot of great people on this channel. And if you just stay plugged into this channel alone, you're going to come across some really good people that are going to be able to leverage your money if you don't feel, see fit to leverage it in an asset that you feel comfortable investing in. Give it to somebody else that you trust, because it's worth playing. It's worth being in this game.
Well, thank you for that. And again, thank you for your time. And for those of you who attended, I hope that this was a helpful presentation for you, gave you some ideas and some expertise that you can use in your own investment strategies. And until the next presentation, I hope you have a great day and happy investing, and we will see you on the next one. Bye, everybody.
Bye. Thank you, everyone. Have a great day.